On this channel, I have made over 40 videos about my portfolio sharing my buys, sells, dividends received, and so much more. And honest to God, I think this is the video that I have been most excited to make. So today, I will be ranking every stock and ETF in my dividend portfolio currently on a tier list from S tier to F tier. For every stock, I'll explain my investment thesis on the company, if I've made any mistakes, what I did right and what I did wrong, and we'll try to take a lesson away from every stock today. And if you appreciate the transparency and me showing my losses and successes in the stock market, help me out by hitting that subscribe button. I'd really appreciate it. Now that you've done that, roll the intro.
Hello, I like money.
Alright, the first company that I'll be talking about today is Visa stock ticker V, and for Visa, I put it in the S tier. Financially, Visa is as sound as a company that you can really get. They have a very easy to understand business model that is recession proof and will last for decades. Visa also rewards shareholders in the form of share buybacks and juicy dividend payments and increases frequently. They're in a duopoly right now with MasterCard in the payment processing industry. And frankly, I think it's impossible to compete with MasterCard or Visa, which is why I'm so bullish on them both. Visa is definitely a stock that I'm going to be holding for a very, very long time in my portfolio, and I'm very bullish on them long term. As for right now with my buying and selling status with Visa, I'm probably holding right now as I do think it is a little expensive, but if it gets by 220s again, I will definitely be adding to my portfolio. The next company I'm going to be ranking is Apple stock ticker AAPL. For Apple, it will be joining Visa in the S tier. Apple is one of the highest quality companies in the world, and even an argument can be made that they're the highest quality company in the world. Apple's continuous innovation and finding new things to add to iOS and making new products is crazy. Just when you think they can't make a better product, they make a better product. Apple rewards shareholders through big share buybacks. They don't have crazy dividend increases yet, but I think as they continue to mature as a company, large dividend increases will be on the way when they don't see better fit to do with the cash. I think Apple also has a lot of potential with their financial services that they're offering right now and their healthcare business. So for all those reasons, I am putting Apple in the S tier. For Apple, I'll just be patient. I'm not buying any right now, but I'm holding. The next company that I'm going to be rating is a company that we've been talking a lot about on this channel and a lot about in the Discord link in the description. And that is, of course, Target. Now, Target has been trading really down recently. Last year, they dropped nearly 20% due to what I believe were systematic risks, and I still believe that to this day. And recently, they've had a dip due to the boycotts over the LGBT products and the recall of them. I believe that these are short-term issues, and if you guys know me, I am a long-term focused investor. This is a company that I'm going to be holding for 30 plus years. My investment thesis on Target, I believe as the US economy continues to grow overall, Target will follow along with it. People are not going to stop shopping at Target, and people are going to forget this ever happened in 5 years. As we saw in 2021, the stock was trading near $250. This is a company that investors want to own when times are great, but when all of a sudden there's an issue or something that happens to Target, the stock sells off nearly $100. Make it make sense? Yep. This is a company that just raised its dividend 20% just a year ago after they traded down 20%. I put Target in the B tier due to the current issues that they're facing, both systematic and not systematic. I think my B tier quality companies are still very solid companies. The next company that I'm going to be reading is Walgreens Boots Alliance stock ticker WBA. This is a company that I may or may not have sold off. You'll have to look in the Discord. This is a company that I feel a couple years ago was trading near B/C tier at a solid company, and I bought in just thinking that they would continue that with no research whatsoever. This was a few years ago, keep in mind. I would consider them to be an okay quality company to own, but right now they are closing stores. Their payout ratio is going up, which is a big reason that I bought in the first place, was because of the low payout ratio. I thought that they would be able to raise their dividend. Financials are going down. It is not looking good for Walgreens right now. I actually just made a Walgreens video where I go pretty deep into it. Yes, that's what she said. But I just don't think Walgreens is a good/great quality company, which is what I only want in my portfolio and what long term I'm transitioning my portfolio into. Next, we got 3M. Now, 3M is a company that I feel just a couple years ago would be in the A or even B tier for many dividend investors. Unfortunately, 3M has been a pure example that no matter how big or strong a company is, the future is unpredictable and anything can happen. They've been swarmed with lawsuits over the last couple years. The loss is expected to be huge for 3M and it will impact on their financials. As a result, they have not cut their dividend yet, but dividend growth has been very poor over the last few years. Currently, 3M's actual business and its segments have not really been impacted by these lawsuits, as they still are performing pretty good. With that said, over the last couple of years, the stock has nearly been cut in half in price, and I think there are some risks definitely. I would normally put 3M and their actual business in the A or B tier, but just because of the risks, I am putting in the C tier for now and the lack of dividend growth. There was actually a big update recently on the 3M lawsuits, and I made a video about it. You could check it out in the top right now or in the link in the description. And currently with my situation in 3M stock, I'm holding as the moment. If I had a lot of capital, I would probably add. Next we have Kroger, and for Kroger, I put it in the A tier. Kroger, I would argue, is the strongest grocery company in America right now. They are the most recognized grocery brand in America right now and own also a lot of other brands of grocery companies, which I don't think people really fully understand. They have an Albertsons merger that could possibly go through, which would be huge for their business. If that goes through, I would argue that Kroger has very monopolistic qualities over the grocery industry. I also believe that Kroger has a lot of potential with AI and automation, and I don't think it's being recognized as a company like that right now, and I have Kroger as a buy in my portfolio. Financially, Kroger's also a very sound company with great revenue, free cash flow growth, etc. They also just hiked their dividend, if you're a dividend growth investor, 11.5%, which I love to see. This summer, I want to build up Kroger as a core position in my portfolio, and I like the stock anywhere between $40 to $50 right now. Financially, though, I just love Kroger's business, and I believe the future is very bright for if you're a Kroger shareholder. The next company I'm going to be talking about is Disney, stock ticker DIS. Now, Disney actually just re-extended Bob Iger's contract through 2026, which I think is a first step in many things that they needed to do to reevaluate their business. They've had a massive reconstruction of their business over the last few years. Unfortunately, with Disney, kind of like 3M, I felt like just a few years ago they could have been in the A tier with their brand value, pricing power, etc. Now, unfortunately, it's in the C tier for me. Unfortunately, over the last few years, I really do feel that Disney's brand value has deteriorated. But I think, though, if there's one man to get Disney out of this hole, it is Bob Iger. Disney really needs to focus on staying out of politics, really revamping up their media quality. I think that their quality in their, movies and stuff that they've been producing has not been very good. And I think they just need to really rebuild their brand. They have so many assets and such great brands that they actually own. It would be very hard for me to imagine how they could mess it up. But again, they are in this situation right now. They have a strong parks business right now, which I think they need to continue to capitalize on. Bob Iger earlier said this year that they would be reinstating their dividend near the end of this year. I'm not too sure on how confident that I am personally that they'll be reinstating it. With that said, I do think Disney is an attractive price right now if you are an ultra long-term investor like myself. Unfortunately, I don't have unlimited capital, and I'm not buying Disney in my portfolio right now, but again, kind of like with 3M, I think that Disney could potentially, if you're a long-term investor, this could be a good buying opportunity. Next up, we have Altria, and for Altria, I put it in the A tier. I judge a business based on their fundamentals, and that's how I tier them right now. And right now, I think Altria is a very strong fundamentally business, and that's why I put it in the A tier. They just announced a share buyback program, and they reward dividends with a great dividend yield and solid dividend growth. I know that this is an unpopular stock amongst the dividend investing community. It's unmoral for some people, but for me, I just look at the revenue, I look at the free cash flow, the growth, and I can't say no. A lot of people are questioning Altria as a good long-term stock, and my response to that, they're making new investments in emerging markets such as cannabis, which I'm pretty excited about. Also, people are addicted to these products, guys. Let's not sugarcoat it. Why would we not want to profit off of nicotine-addicted teens who like to blow on flavored air in the school bathroom in the middle of the day? Every time I walk into the bathroom at school and I smell that vape, I just get a good cha-ching in my head and imagine that dividend payment from Altria. I think all the risk with Altria is also overblown, no pun intended, and I think it's already been priced into the stock, and I do think that Altria is a pretty attractive valuation right now. With that said, I don't have Altria as a core position on my portfolio right now, as I do think that there are a lot of risks, so Altria is going in the A tier. Cry about it in the comment section. Next up, we got the railway giant Union Pacific, stock ticker UNP. I didn't understand and realize how much this country really relies on railways until just recently. So this winter, I recently just bought into Union Pacific. I've identified it as a high-quality company that rewards shareholders for share buybacks and juicy dividend payments and growth. Union Pacific has a lot of monopolistic features. I would also say that Union Pacific has a lot of growth potential ahead of them. In a recent shareholder letter, the former CEO Lance Fritz was called out for poor execution and poor business performance and was saying basically that Union Pacific had a lot more potential with the assets they had and a lot of different ways in business, profitability, execution, etc. And keep in mind, I bought Union Pacific before this, but the fact that they have so much more potential, these activist investors think, they have so much more potential for growth in their business really gets me excited. Right now in my portfolio, I own roughly $500 $500 Union Pacific, and I have it at buy near $200 or below. This is a company that I want to have as a core position in my portfolio and continue buying into this summer. Next up, we have the staple stock of the year, which is PepsiCo, stock ticker PEP. Pepsi just released and beat earnings today. Pepsi's an amazing company to own with great brand value, pricing power, etc. The only thing bad I can really find about the stock right now is the valuation it's traded at, and I definitely am not buying at these current prices. Pepsi has a wide variety of brands both in the beverage and snack industry, including Lay's, the Pepsi Cola Company, Frito-Lay, Ruffles, and so much more. Pepsi's also a very financially sound company as well, and I would consider them over Coke right now. Pepsi's also grown their dividend in the last few years pretty aggressively as well for them. A little concerned there about the dividend payout ratio. It's creeping up there. It's a little high right now, but I think as they keep on growing their business, that'll be fine. I would love to add more Pepsi to my portfolio, but again, it is just so highly priced right now. So Pepsi will go in the A tier for now. Next up, we got the shipping giant UPS. UPS obviously is a shipping company, and they run a duopoly right now with FedEx. I think the Amazon risk has already been kind of priced in with UPS. UPS rewards shareholders through share buybacks and generous dividend payments and growth. Just a few years ago, they hiked the dividend a mighty 50%. UPS is a very strong company. With that said, UPS is dealing with some issues right now, both systematic and not systematic. They have currently union issues, which are a big concern for them, but it has not really been priced into the stock. I believe that UPS will get this resolved with all their workers and stuff, and it will not be a long-term issue. But UPS is a very solid giant company. Another concern that investors have about UPS is the recent spike in their financials. Their financials were doing alright prior to around 2020, 2021, but then there was just a huge spike in EPS and earnings per share. A lot of analysts predict this growth to continue, but there are still some skeptics out there. I like UPS personally around $170, $160, and I'll be adding probably around there. UPS is just a very mature and solid company for the long term, which is why I put it in the B tier. Next up, we got Realty, not Reality Income. I actually just made a Realty Income stock review, which I think you guys should all go check out. Link in the description and in the top right corner right now. I think it's one of the highest quality videos that I've ever made on this channel so far. We do a really deep dive into Realty Income's business, tenants, etc. Go check it out. Realty Income is one of those slow and boring companies that I just love to own. They own a lot of boring properties that always pay their rent every month. 99% occupancy rate. I love Realty Income. I put in the B tier though because there's not a whole ton of growth at this point in the company, which I'm fine with. They are expanding and diversifying their real estate across the world right now, which I'm happy to see, and they reward their shareholders through a monthly growing dividend. I love Realty Income because how simple their business model really works. Cold hard cash from real estate, getting good quality tenants in there. I would say that the slower dividend growth is the reason that it's not in the A tier right now, but I love my slow, boring, growing companies. I like Realty Income at the current prices right now, and I actually had a fair price of it, around $68 per share. I will likely be adding more to my portfolio. Speaking of real estate, the next company that I own is a real estate company, technically, which is McDonald's, of course. McDonald's, it's one of the most iconic brands in the world, and I put in the A tier, of course. While the quality of the restaurants may not be the best, it's predictable and you know what you're gonna get. Obviously, McDonald's makes a lot of their money off real estate. With the Grimace Shake and the Travis Scott meal and the other meals that they have on sale, McDonald's is finding great new ways to innovate and get more customers into their stores. McDonald's is a very mature and financially sound company as well and rewards shareholders through dividends and share buybacks. Unfortunately, McDonald's has been recognized as one of the highest quality companies in the world and is trading at a very high price right now. Right now, I'm just holding on to my McDonald's. However, if there is a dip, don't be surprised if you see me adding a little bit to my McDonald's position right now. Next up, we have another iconic brand in the world, which is of course Nike, stock ticker NKE. Now, I bought Nike during the bull market in 2021 at a whopping price of $140 and a very high P ratio. This was at a time where I really didn't understand valuation at all and was buying stocks based off what I knew and the brands. Regardless though, Nike is still very a financially strong company and it has an amazing growing dividend right now, strong growth rates. They don't have a high yield but a great growth rates. Nike is looking to go more direct to consumer, which I'm a big fan of, and I think they'll work out well for them in the long term. Nike has great pricing power, they have great brand value, and any time that you can sell a shoe that costs $40 to make and you could sell it at $500, that's a company that I want to own. Nike is currently trading near $108, way below my cost per share. I only own one share of Nike right now, but I have recently considered dollar cost averaging to get my cost per share down. The next company is Costco, stock ticker COST. Speaking of iconic brands, Costco is probably the biggest branded retailer in the United States right now. Costco is known for their low prices on items, unique business model, cheap hot dog meals, and so much more. I had never been to a Costco until about a year ago, and I was really impressed by the service and overall the experience at the store. It was something that really is truly unique and that I had never experienced before. Their business model is also unique in the fact that you can't just walk in there unless you have a membership. The memberships, which are growing, they're showing pricing power on that by increasing prices, and also that's how they make their money. Costco also pays a growing dividend and occasionally pay large special dividends, which I don't have in my portfolio just yet. Costco trades at a really high PE ratio, but historically they've traded at a high PE ratio and still outperformed the market and gone up. And when I identify a high quality company that I could use as a core position in my portfolio, I found right now that it's better not to just wait on the sidelines, but to dollar cost average. Every Monday, I'm putting $25 into my Costco position. I put Costco in the A tier for its outperformance of the market and the quality company that I think it is. The next company is a trash company, quite literally Waste Management, stock ticker WM. Waste Management is a very strong company, rewards shareholders through a growing dividend. I like Waste Management because of its recession-proof business model. There's always going to be trash in the world, and I think long-term this will be an amazing company to own. As for valuation, it is traded a little higher valuation, and I had only previously owned one share, but I have gotten back to buying and adding to my Waste Management position as of recently. Waste Management was one of the first stocks that I ever bought in my portfolio, and has performed very well, and I'm up nearly 46% on that one stock right now. Waste Management is a company that I definitely want to build up my position in over the long term in my portfolio, and don't be surprised if you see me adding to my Waste Management position soon. The next stock is a company that I've been known to talk about a little bit on this channel, which is of course Starbucks, stock ticker SBUX. Right now, if you look up Starbucks drinks on TikTok, you will see thousands of white girls reviewing their favorite Starbucks drink that they overpaid for. This type of brand value is something that I want in my portfolio, and I believe Starbucks has one of the highest brand values in my portfolio out of all the companies. They have also shown great pricing power during last year as they hiked prices on their drinks, and people are still buying them at the same time. The biggest drug in the world right now is caffeine, and I want to benefit off that myself. Starbucks has reoccurring customers, and they actually act as a bank through their Starbucks app. People load money on their Starbucks app, where Starbucks basically gets to keep interest free, which they can use to make new investments, build new stores, pay juicy dividends to investors like me, and more. Speaking of dividends in Starbucks, Starbucks also just had a really nice dividend hike near 18% last September, and they are set to hike it this September as well. Now, Starbucks has been on a bit of a dip recently, trading in the high 90s, and people have been asking me if I'm going to add to my Starbucks position. I think for me to add to my Starbucks position, it would have to dip back in the low 90s, 80s, even 70s, and I would load up again like I did last year. My cost per share on Starbucks is dirt cheap right now because I believed in the company when nobody else did last year. I can truthfully say that Starbucks is one of my favorite companies that I own in my portfolio, and I put it in A tier. The next company is Hasbro, stock ticker HAS. Hasbro is one of the first stocks that I added to my portfolio when I started investing. My investment thesis on the company was that kids are always going to be using toys, but that has proven out to be wrong. I bought 3 shares in the 90s and 80s, and so far it's trading in the 50s and 60s. This is really one of those weird holdings for me where I really don't know what I want to do with it right now. I was talking with Physical Philosophy, and he said that the impact of kids being on gadgets like iPads, phones, etc. could take a toll on them in the long term, and that's something that I really never thought of. Right now, for my Hasbro stock, I'm holding on to it at the moment, but I'm going to do some more research on the company and why it's down, its performance, etc. Lack of dividend growth is not a good thing for me right now, and no share buybacks with them as well. I blame this on my poor investment thesis, lack of knowledge about investing at the time. With that said, thankfully it's only 3 shares that I own, so right now, as I continue to evaluate what I'm going to do with it, I'm most likely going to hold. The next company is Microsoft, stock ticker MSFT, and of course you guys know I'm putting Microsoft in S tier. Microsoft is my favorite company in the world right now, and I think it's the highest quality company in the world as well. I think Microsoft has so much potential with their gaming segment right now, especially since that Activision Blizzard deal went through in the US at least. Abbvie Nikon. Microsoft is financially sound as a business you can get, and they reward me as a shareholder through great share buybacks and juicy dividend payment and increases. For me, anything under $230 with Microsoft is a steal. I have it at a buy from $250 to $280, and anything under $280 to $320 I think is fair price. Right now, I'm just holding out on my Microsoft. I already have a lot of gains in the company, but this is a company, a stock that I'm literally going to be holding for the rest of my life, letting my dividends reinvest, grow, compound, etc., and I'm looking forward to it. Next up, we got the utility growth stock NextEra Energy. NEE has really solid dividend growth, and of course it's the utility, so very monopolistic features on this. I haven't had an opportunity to really add to my NextEra Energy position in a long time. This is a company that I'm going to do more research on and try to understand the business more fully before I add more. I think as utilities go towards more green and quote-unquote clean energy, I think NextEra Energy will benefit that as well. And as for NextEra Energy in my portfolio, I like it in the low 70s. They do have really solid dividend growth as well, as I mentioned, so this is definitely a company that I'm going to be looking to add more to in my portfolio if it hits the low 70s. Next, we have a company that I bought during 2021, which is Corning, stock ticker GLW. They make a lot of glass products for companies like Apple, car companies, and more. This again is kind of a smaller position in my portfolio, and I'm not totally in love with the company. I don't see myself holding it for the rest of my life. Again, they are not a bad company whatsoever. I put it in C tier. They're a decent quality company. They have some alright dividend growth, nothing to write home about, and their financials are kind of the same, so I'm kind of reevaluating what to do with Corning right now, but for me personally, I'm just holding on. So for now, Corning is in the C tier. Next, we have the popular Las Vegas REIT VICI. I have done a VICI stock review. You can look at a link in the description or in the top right corner right now. VICI is one of the most popular REITs coming up recently, as for Joseph Carlson fanboys like Alex Rezzi promote the stock on Discord. With that said, VICI actually does have some very high quality properties in the Las Vegas area, and they are expanding and diversifying across the world right now. They've only been around for a few years, but they do have really solid dividend growth, so I think if you're looking to get some real estate exposure and you think Realty Income's dividend growth may not be great for you, I think VICI is a great alternative. I love the CEO Ed Pitoniak and how transparent he really is, unlike a lot of these other CEOs. I like VICI under $33 right now, and I've been adding to my portfolio right now with VICI under 32 on 31, adding around that area when I can. I've been building up my position as of recently, and I'm happy where it's at right now, and I'll probably continue to buy more if there's any big dips. The next holding is an ETF, but I'll put it in here anyway, which is SCHD, of course, and for that I put in the S tier for its great dividend growth and dividend yield. Gives me great exposure. It'll be interesting to see what their annual dividend payout is for the remaining 2 quarters this year. I'm looking forward to see if there's any increase or not, and I hope there is. I dive really deep in why SCHD is so beloved and what makes it different from other dividend ETFs. Check that out, link in the description or in the top right corner. With that said, I already have a lot of SCHD in my portfolio, but if it gets below $70, don't be surprised if you see me add more. Next, we have Warren Buffett's company, Berkshire Hathaway, which I had to put in the A tier, of course. Berkshire Hathaway is the first stock that I ever bought when I started investing, and I bought it at a mighty $210 compared to today's roughly $340. Berkshire continues to buy back shares right now, which makes me confident that they think it's undervalued, so I've been recently debating adding to my Berkshire position. Berkshire is a holdings company of companies like Dairy Queen, Geico, and more. Warren Buffett's the greatest investor of all time, and I'm definitely willing to invest my money through him. Again, I am looking to add to my Berkshire position right now at some time if I see any significant dips. Of course, join the Discord link in the description if you want to see all my buys, sells, and dividends before portfolio updates every month. Next, we got the pharma giant Abbvie, stock ticker ABBV. Abbvie's a company that I've been actually adding to recently as they've been on a bit of a dip. I like Abbvie at 130, 140, and don't be surprised if you continue to see me adding to my Abbvie position. Everybody's going to always need healthcare, and Abbvie has a lot of that for sure. They own hundreds of brands and drugs used by people every day. Abbvie is also a very financially sound company with a great dividend yield and juicy growing dividend. They're trading at a cheaper PE right now because of the Humira patent that's expiring right now. Abbvie's lawyers are going to do as much as they can to kind of extend that patent illegally as much as they can. But a big thing that people don't keep in mind with Abbvie is that they still can produce Humira and get profits from the drug. It's just that other people can make the same thing, so they're going to be getting less at the end of the day. Thankfully, though, Abbvie is building up their other business segments long term to make up for these potential losses from Humira. Overall, as I mentioned, I like Abbvie 130, 140, and don't be surprised if you continue to see me adding. Next up, we got Coca Cola, which I put in B tier. Coke has just slowed down a lot recently, but you guys know me, I love slow, boring, growing companies like Coca Cola. I don't love their dividend growth, though. It hasn't been as aggressive as I'd like as a dividend growth investor, but what do you expect from Coke? I had some worries long term that people could potentially stop buying Coca Cola products because of how unhealthy they are. As somebody who's really into sports and exercise science and health nutrition, it doesn't take a genius to realize that these products aren't healthy. Thankfully, I did a little more research and they are expanding into some more health conscious brands. For example, Fairlife, I'm a big Fairlife guy, Smart Water, and they own a lot of other beverage brands such as Fanta, Sprite, they have Costa Coffee now. Overall, though, Coke is just a large, giant company, and I don't see it going anywhere for a long time. So right now with Coke, I think it is a little bit overpriced, so I'm just holding on to it right now. I do think Coke is the better buy over Pepsi at the moment based on valuation. And last but not least, we got Johnson & Johnson, stock ticker J&J. I know Pierre from PK Investing isn't going to like this, but I have not been adding to my J&J position recently. With that said, I do think that it is attractive in the 150s where it's at right now, and I could potentially add to my portfolio soon. J&J's dividend is slow, growing, and boring, just along with their business, which I like. You aren't seeing crazy double-digit growth from the dividend out of J&J, but again, those consistent 4% hikes every year are nice. They're a large and mature company, and it's a giant too. I put J&J into B tier, but that B tier, those are still very solid and high-quality companies as well. And that, ladies and gentlemen, is the video. Please let me know your thoughts in the comment section. I know there's going to be controversy over some of these rankings. Thank you again for making it to the end. It really does mean a lot to me, and it helps me reach my goal of getting monetized. With that said, if you'd like to meet other like-minded investors and talk more about dividend investing all day, join the Discord link in the description. If you haven't already subscribed, I don't know what you're doing. And of course, thank you for making it to the end. And do dividend stocks, not drugs. Have a good one.